Good afternoon, everyone. So just a little bit about my background, if some of you who don't know. So I come from institutional background. So I pretty much come from institutional background. I've worked 15 years in trading for large institutions, and some of you may know the bigger institutions such as Bank of America. I've worked as an equity trader. In Bank of New York Mellon, I have worked as a hedge fund trader, so as a fund of fund trading, and currently providing research services to Avatrade. So I do have experience working with institutional clients and, of course, with the retail clients. So the presentation which I'm about to give to you guys is a combination of both. So, of course, it has an element for you guys to understand the basics of technical analysis, but I'm not going to go too much detail in the technical analysis because throughout this 15 years of my experience, I have traded markets mainly based on fundamentals and what really drives those price actions. Now, back in 2013, when I did my chartered market technician's qualification, and by the way, I'm sure many of you know, in order to do a chartered market technician for a level 1, you have to read 9 books to pass 1 exam, and then you have 3 exams just like that. So for me, in my perspective, technical analysis is good and great if you wanted to find the general levels in the price for the entry. But if you are a macro-based trader, then you wouldn't really care too much about it. But we'll go through some of that now. So before we begin anything, as always, it is important just to go through the disclaimer. Nothing can be perceived as an advice, and the full disclaimer is right in front of you. If you wanted to contact, that's the Twitter handle for myself and for the company that I provide services, Avatrade. And on a daily basis, all the research is given to you guys for free. In addition to that, every day I do YouTube Live, so that is your opportunity to get in touch, ask any questions as you want. Even that is an interview on a television that I have done previously or I'm about to do. If you want me to discuss anything, because part of my role is to provide contribution to tier 1 media such as BBC, CNN, and all of that. So that's what we do. So, and I have to say that the terminal that I'm going to use, or the presentation throughout, it will be all the shots are taken from my own Bloomberg terminal, which is licensed. So we're going to explain a little bit in detail for that. So what do you have right in front of you guys? Can anyone tell me what 2 asset classes are there? Okay. And why? Okay, good. So over the last 10 years or so, 2 asset classes have come out very, very strongly. Of course, we all know gold, how gold is always a safe haven asset and how it has always acted like a safe haven asset. But more recently, Bitcoin has also acquired that reputation to act like that. So what do you have over here? It's in a blue line. Let me see if I can get the pointer. So this one is the blue one is your price of gold, which is going to be on that side. And Bitcoin is your white, which is on this side, almost 20,000. And right over here, sorry, let me go back. Right over here, the one in green and the one in red. Anything which is in green, that shows you the positive correlation, meaning when gold prices are moving higher, then Bitcoin prices are also moving higher. So that pretty much just indicates the correlation between the two, because this year what we have experienced back in March was both gold prices and Bitcoin prices falling at the same time. And the biggest qualm or the concern among investors and traders at the time was that, okay, why both of them are not acting as a safe haven asset? And the reason was because there was a huge panic in the market because of COVID crisis. And investors had to sell their gold positions in order to protect themselves from a margin call in their portfolios, in their hedge funds. And that was the only major reason that why we've experienced a massive sell-off in gold prices. But with respect to Bitcoin, we should have seen a massive rally in a Bitcoin because it is against the monetary policy, which is a very different topic altogether to discuss. But we should have seen it, but we didn't. And the reason for that was, once again, very much similar, that yes, investors who have invested in other alternative assets, such as Bitcoin, they had to liquidate those positions to take the money out of that asset class and then protect them. And then came the massive monetary policy from the Federal Reserve over in the United States, something which was completely unprecedented. And gold prices started to rise massively. We hit all-time high, above 2,000, and that was primarily driven by the monetary policy by the Fed. And by the way, today, in a few hours, we are going to get a decision by the Federal Reserve which is going to move the gold prices enormously. Why? I'll explain that in a few minutes. So when gold prices started to move higher, just like how it happened right over here, because Fed was printing a lot of money, they were trying to assure the market that the support is going to be here, so that is good. And the same thing happened back in 2009 and 2007 when the financial crisis happened. Because at the time, gold prices hit an all-time high of nearly $1,600 to $1,700 per ounce. So now, the same circle, exactly the same situation is about to happen possibly again. Because we have a vaccine, economic growth is about to return, and this price of gold, which is sitting in around this area, which everyone was saying only a couple of months ago, that gold prices are very much likely to go to $3,000. And these calls have been made by major institutions. For some of them I have worked, as I've mentioned. But the biggest bold call on the market was by Citibank, which believes the gold prices are going to go to $3,000. But the reason, if history repeats itself, because we have a COVID vaccine, that means economic activity can pretty much return to the previous level. Business activities can return. You guys be able to do a better business now because people will be traveling. So that means the Federal Reserve doesn't need to provide that much liquidity into the system, meaning no more monetary policy, money printing from the Federal Reserve. Now let's have a flashback. Back in 2011 or so, when we were literally coming out of a financial crisis, the Federal Reserve didn't increase the interest rate, but it just, because Federal Reserve has two different components in terms of a monetary policy. One is the asset purchase, the other one is the interest rate. The fear in the market was that the Federal Reserve will start increasing the interest rate. But they said, you know what, we're going to supply less money in a very simple term. We're going to start supply less money in the market. That triggered the sell-off in gold prices. And gold price went all the way to $980. That was the low during after the financial crisis recovery. Now, are we going to go to that price level? We will come to that as well. But now, as of today, at 7 p.m. UK time, so just minus the 4, so it'd be about plus 4, so I think it's about 9 p.m. We're going to get the Fed decision, the UAE time. The Federal Reserve is going to come up with its forward guidance decision. That forward guidance, if the Federal Reserve thinks that, look, we have the COVID vaccine, things are going to become better, this price of gold, which is trading currently, I've just checked it, around 1,850 or 1,830, it is going to get a sharp drop. Because that means the Fed is going to supply less money into the market, and the next step would be something even more bigger. And market will react to that. And that particular event is going to set the trend for gold prices going forward. This, as a hedge fund trader, as an equity trader for bigger institutions, these were the indicators that we used to pay more attention to. What is the macro policy? Where the central banks are moving to? And based on those ones, we used to make our decisions. So, how the gold has performed overall for the last month. This one right over here already shows that gold prices have dropped 5% because institutional traders, hedge fund traders, in fact, Warren Buffett, remember about 2 quarters ago when 13F filing came, he went back into a gold stock because he couldn't really buy gold directly, but he did. But the recent 13F filing, he came out of that stock. So he doesn't have an exposure to gold. So for the last month, gold prices, because anything which is below zero represents the percentage drop, anything above is a percentage gain. So for the last month, as you can see, gold prices have fallen more than 5%. But gold rally has stumbled since the metal reached, again, the same. There are signs it could be in for a rough ride for heading into next year, 2021. Now, this chart over here is very, very important because what this one shows you, do you guys know exchange traded funds, ETFs? Anyone who doesn't know ETF? Raise your hand, feel free, because I understand this is a retail crowd. Perfect. So, with institutions, you have exchange traded funds. What they do is you put money in and then they go and then they buy the asset itself, whether that is gold, whether that's oil, whether it's a stock. So the chart which is right in front of you, what it's showing to you guys is that the total known physical gold sitting in those ETFs on these exchange traded funds. What it shows is that as the prices were taking nose down, the physical gold in those funds is also reducing as well. Because sometimes what happens is that the prices are retracing, but you don't know what is going on back behind the scene. So sometimes the prices are dropping, but the physical holding in those ETFs are increasing at the same time. So that shows that the current retracement or the current pullback in the price is no longer going to be valid. It is highly likely to be, we will see a rally. But right now, according to the most recent data, the total known gold ETFs holdings in those ones have increased massively. So this further confirms that, okay, there is a stronger possibility of gold prices to continue to move lower rather than going up. Now the chart, which is right in front of you right now, this shows the short positions by large speculators. Now again, this is your hedge funds. So if you wanted to know what hedge funds are really doing, are they increasing their short positions or are they decreasing their short positions? Look, as the price started to rise, what we're seeing is an increase in those short positions. So again, pretty much confirms 3 different narratives. Number one is as gold prices are going down, the physical holding of gold in those exchange traded funds are also reducing. And then lastly, the short positions have also gone down. This particular one just shows you that despite all the narrative, now the narrative, I wanted to slightly change the narrative because there are still possibilities. You have to be prepared and be ready for both sides of the trade. This particular chart shows you something different because so far we have only talked about the bearish side of the coin, right? So I've only talked about the gold prices are going to go and they're going to continue to move lower. That's all what I have talked about. But let's flip the situation. Let's have an argument that why gold prices can actually go higher at the same time as well. One of the biggest reason is that the Federal Reserve is in a very, very tight spot with respect to their monetary policy because the debt that the US is sitting on is massive. It is literally not possible for the US to pay back its debt. And with what Trump has done for the last 4 years in terms of a monetary policy and the way the interest rates are sitting, it's going to be incredibly difficult for the Fed to increase the interest rate. Because the moment the Fed will increase the interest rate, it becomes even more expensive. So let me give you an example, a very easy example. Let's say that you own a house or a mortgage on a house. What happens when the interest rate goes up? Obviously, your mortgage payments goes up. It becomes more expensive for you. So the survival for your daily life becomes quite difficult. With the Federal Reserve, the situation is very, very same as well. So for that particular reason, and with what Trump has done, there are still stronger possibilities that gold prices will continue their journey to the upside. And if you see this particular chart, it pretty much shows you that you have 8 quarters of gain, not even a single quarter. Gold prices have gone down. All right, so in terms of oil, I'm going to tell you my real story about what happened during this year with respect to oil prices, really. I made a bet, so obviously being in the industry for 15 years, this was the 3rd time that I was actually looking at the crisis. Again, the same film playing back again. And we took advantage. We went into equities, myself and another friend. We went into them, started buying equities, did really well because we bought it on the 22nd of March. And to our luck, and purely our luck, the market formed the bottom on the 23rd of March. My criteria that I went in, and then I must explain this, that out of my total capital, for example, if you have £100 or 1 million, the S&P 500 index dropped on the 22nd of March by 30%. That's what pretty much approximate that. I only invested 65% of the capital. The rest was still remaining in my account despite the fact the index dropped to 30% because I was expecting for the market to drop even more and then buy it at a lower price and then average down my price, something that we used to do also on the institutional, on the hedge fund side. So that was my strategy. So I did not deploy my 100% capital on the 22nd of March because I was expecting for the market to go even more down. It didn't. To our luck, the market formed the bottom on 23rd. Or you can say to our sadness or to our bad luck, the market didn't go further because I was expecting for the S&P 500 index to drop more than 50%, 60%. It was unprecedented event ever happened, and we could see that how this economic disaster is really going to be. But because of, and why that didn't happen, because the Federal Reserve learned the lessons from 2009 crisis. The Bank of England, the ECB, the BOJ, all the central banks, they had a very coordinated action. When we started to see this coordinated action from the central banks, it was very clear that we have a stimulus and the monetary policy support. Market is unlikely to drop any further from here. Despite all the positiveness, did not deploy the 100% capital. So I'm going to cut that story short. On the equity side, we did really well. But something unprecedented also happened in the oil market as well. Because of economic crisis, everything started to drop massively. Oil prices went negative. We went in and bought oil contracts at the price between $14 to $15, thinking that we are buying something at a 30-year low. The size of the bet was 25,000 in monetary value. And we were comfortable. The first rule of anything is that you need to be comfortable with whatever you put in. So we were comfortable losing that money without breaking a sweat, because as a part of the portfolio, that was a very small position for us, so it wasn't really going to make a huge difference on us. So we were okay. And for us, that was really a bet, because the prices were trading at $14 or $15. We were expecting, by looking at the options market and the future curves, we were expecting oil prices to touch 40 at the max by the end of December. But we all know what happened. The prices went very quickly to the upside. But when the prices were trading at $14 to $15, it continued to move lower. And at $8, I was down by $8,000. I called my friend, and then I said, I think it is going to go further down. I'm going to take this loss, which we are okay to take at 25,000, but I think the market is going to go even more down, because this never ever happened. And the biggest problem at the time was you couldn't get the storage. That was the main problem. You have oil, but you don't have a place to put it. That was the main issue, what happened. So we got out. So we lost that $8,000 in that trade, but it was okay for me because it was pre-planned. Wasn't something. So, factors that can drive prices lower: pandemic, banking crisis, supply war. Pandemic, obviously I've explained to everyone. Banking crisis is a still very real threat over in Europe, because banks have too much leverage on their balance sheets, and there is no actual indication of these smaller to medium-sized companies giving those loans back. Something which is not priced into the stock market, something which is not priced into the sentiment at all. Right now, what is priced in, I'll give you an example. Let's say that you own a warehouse, right? Because it's the logistics. Anything which has really gone very high during this period is your logistics business. Let's say you own a warehouse. Now, over in Europe and also in the United States, what has happened is that, okay, so you have a mortgage, bank says to you, I will give you a holiday for 1 month. Okay, so you don't have to worry about for your mortgage payment for 1 month. That's okay. But the business who's renting the premises from you hasn't paid you rent for 4 months. And these are the real examples I'm speaking of in Europe or in the United States. And I'm also speaking of the places on the Fifth Avenue. Very prime examples. So what is going to happen? This is a debt. This was a mortgage which was issued by a bank, and it is sitting on a balance sheet on someone's. Obviously, this represents the actual banking crisis, which we haven't come to yet. And the supply war, again, between Saudi Arabia and Russia, that can also happen going forward as well. Now, in terms of the performance, so far, as I've discussed earlier, the oil prices have performed a massive rally. So in terms of a weekly chain, because each bar over here represents the change in oil prices on a weekly basis. So you can see that there are literally still 6 weeks of gains when it comes to oil prices. And I'm going to come to one particular slide towards the end of this presentation, which is about something quite intriguing. I don't want it to give out too much. Again, this is the same scenario which I've discussed earlier in gold prices, but a slightly different way. Because what you have over here in these bars over here, this shows you the short positions on gold prices by on oil prices by bigger institutions. And over here, right on this side, this shows you the price. So the white line is the price of oil, and then these bars, this shows you the short positions. So what this indicates is that oil prices are likely to continue to move higher which makes a lot of sense because you do have a coronavirus vaccine. Economic activity is about to kick into a higher gear going into 2021, so that can certainly happen. And another parameter, this is quite an important one. When I was trading oil, when I lost 8,000 on that particular trade, we were also paying attention, very close attention to this particular slide. This shows you floating oil in tankers in the sea. Because the less it becomes, the lower it goes, it shows you have a less supply out there, and that means the demand will go up. That's what pretty much it explains. And this is what we were looking at. At the time, obviously, the situation was sitting right over here. And when it is like that, the biggest trade at the time is to buy oil tanker stocks. Because you have too much oil, you want it to store somewhere, what other way is to do rather than buying oil tanker stocks? And then if you see, I don't have a time because obviously moderator is here, so you have to wrap it up fairly quickly. But that is one of the counter trades. So whenever oil prices will go back to $15 or a $10, remember and mark this moment. You wanted to look into oil tanker stocks, companies which provide oil tankers. All right. This is very, very intriguing, and this is what exactly I was saying to you guys, that why this is quite an important slide. So using the Bloomberg terminal, I'm sharing this strategy for you guys in a very transparent manner. So what we have done, we've done the back-tested a portfolio on a particular strategy. And what I've shown you is the total trades, wins, losses, P&L, percentage of P&L, but the statistics over here is more important. This is a certain moving average. The principle is very same. The price crosses above that, you buy, crosses below, you sell, and then you continue to do that from what period? From May until now. It's an intraday time frame, 60-minute. What moving average it is exponential moving average, 74. Because using the terminal, you can, if you know a little bit of coding and stuff, then you can check. So what I did is like, okay, tell me which particular moving average works best on any particular time frame, and this one has a pretty good results. What I want you guys to focus quite over here is right over here. Average loss and average win. Look over here. Total number of winning trades are only 54, but losing trades are 187. The P&L for the total time period, we are still up 39%. So by losing so many trades, I'm still, according to this particular strategy, and this strategy is 100% correct because I've tested it on a Bloomberg terminal. I can provide you tick-by-tick data. I can provide you the trade. I can provide you the timing, everything on that. So consider it that you were actually taking the trade on the 1st of May, and this should be your P&L right now, today. 39%, whatever the original capital was. But the key thing is that when I was testing this strategy, stress testing it, I had to make sure that my average win and average loss is very much in line, because this is a 100 million portfolio. So my average win is 4.53 million, while my average loss is nearly 700,000. Hope that helps. Thank you.